Grant Cardone really isn't in a good position at the moment. Most of his funds over at Cardone Capital are significantly underperforming. He hasn't been able to bring in enough rental income, he actually hasn't been able to go out and buy enough properties, and worst of all, he hasn't been able to return enough to those investors. In this video I'm going to be reviewing the recent financials for Cardone Capital, which is owned by Grant Cardone, and also reviewing the interim financials for the first 6 months of 2020. I'm also going to be explaining why his funds are underperforming and why they aren't returning enough to investors. But before we get started, if you've got any questions about anything I say today, then be sure to drop it down below in the comments and I'll answer it whenever possible. Also, this video isn't meant to slander or to bring into disrepute the name of Grant Cardone or Cardone Capital. I'm just simply giving my opinion on the publicly available financials from the SEC website. I don't do the accounting for Cardone Capital, nor do I audit them, and therefore I don't have any insider information. I'm just making some assumptions on the information that's contained within those financials. So as a quick summary, Cardone Capital is split into multiple investment funds. Funds 1 and 2 are smaller funds only available to accredited investors and high net worth individuals. Fund 1 raised around $5 million and Fund 2 raised around $8 million. Funds 3, 4 and 5 are much bigger, raising $45 million, $106 million and $50 million. Now before I delve deep into the financials and start unravelling the problems at Cardone Capital, I want to point out the problem that these bigger funds cause. So let's assume that Grant uses this money raised from investors as a 25% deposit on a multifamily property or multiple properties and finances the other 75% externally. Now obviously it's not quite as simple as that because the borrowings or the gearing in each of these funds differs. Might be 75% or higher, maybe slightly lower. But let's just assume that it's 75% just for the moment. This means that in funds 1 and 2 he needs to buy properties that are worth $20 million and $32 million because, for example, $5 million is 25% of $20 million. Now if we look on LoopNet or Zillow, that's not too much of a problem. In Florida there's a few apartment complexes listed for around this amount or lower, so we could obviously just buy one big apartment complex or maybe 2 smaller complexes. He's also got quite a number of different complexes available. Therefore, if one big complex didn't generate enough profit, he could buy 2 or maybe more smaller complexes that do generate enough profit for him. This is fairly similar to a regular person like you or I buying a property for around $200,000 or $320,000. If you look on LoopNet or Zillow or any other website, there's plenty of properties available and I'm sure that you can find a good investment. The law of total probability suggests that the more opportunities that you give something, the higher the probability of getting a desired outcome. Basically, the more properties that you look through and the more properties that there are available to invest in, the higher the chances of finding at least one that's a good investment. But in funds 3, 4 and 5, Grant would need to buy properties worth $180 million, $424 million and $200 million. So nearly $800 million worth of property. And this is where the problem arises. If you look at the whole first page of LoopNet, and if Grant buys every single complex on that first page, he's only got around $300 to $350 million of property, so massively short. The other problem is that Grant Cardone would have to buy all of these properties, regardless if they were a good investment or not. Grant tends to aim for an internal rate of return of around 15%. Obviously, if one of these properties only delivered him, say, 12%, he'd still have to buy it to be able to deploy all of the investor's money. This is the equivalent of you or I not buying a property for $200,000 or $320,000, but for $8 million. Now, there's just a lot less properties available on the market at that range. You might not be able to find one that you like or be able to find one that's a good investment. It's just a much smaller sample size. Grant always preaches about how cash is trash and you should get it out of the door as soon as it comes in. And this is somewhat good advice because you definitely want to get most of your cash out there invested and earning you money instead of obviously having it just sat in a bank doing nothing. But it seems like Grant might be having that problem of not being able to get cash out of the door fast enough. He's got all of this money from investors, but the properties for him to invest in just aren't there. There's not enough for him and maybe they're just not good enough. And therefore he's got quite a lot of this money just sat in the bank, not really doing too much. Or maybe he has managed to deploy all of that funding into properties, but maybe he had to settle for some subpar deals. I guess we'll find out shortly. If you're enjoying the video so far, be sure to drop a like down below and subscribe to the channel if you haven't already. It really helps out my channel with the YouTube algorithm and helps me make more videos just like these for you. So let's start reviewing the financials, and let's start at the top with Reserve at St. Lucie or Cardone Equity 1. Now this fund is quite small and is obviously doing quite well and is open to only accredited investors. The fund has been consistently generating around $2.7 million a year in rental incomes. Now remember, for 2019, that's only a 9-month period, not the full 12-month period. Therefore you have to times all those numbers in the profit and loss by 12/9. The operating expenditures and interest expenditures are less than the rent, which is obviously a good thing. Apart from the amortisation and depreciation, which is effectively just a revaluation or the recognition of the reduction in value or the potential reduction in value of that property, not any physical cash payments. And therefore the fund is generating a profit and returning money to investors. A great start. It also has around $19 million of property, which is also good. Remember earlier that I said that as Fund 1 raised around $5 million, that it'd need to buy around $20 million of property. $19 million is very close to $20 million, and therefore it's pretty much done just that. Also good. The liabilities, which are the external loans, are about 75% of the asset values, meaning that Grant has used about a 25% down payment for those properties. Although Fund 1 is fairly highly geared, it means that Grant has managed to deploy all of the investors' money and is making good returns on all of it. Up next is Reserve at Ormond Beach or Cardone Equity 2, which consistently generates around $4 to $4.2 million of revenues or rental incomes. The operating expenditure and the interest expense is less than those rental incomes, and therefore the fund also makes profit and distributes cash back to the investors. This fund has around $37 million of property, which is good. It means that Grant has fully deployed all of the investors' money and actually has been a bit more aggressive, using a bigger loan or therefore a smaller down payment on each property. Moving on to Fund 3, we can see that this fund generates $11 to $13 million of rental income per year. Again, the operating expenditure and the interest expenditure is less than that rent, and therefore the fund generates profit and distributes cash back to investors. Although, this is where the problems start to show. So far in Fund 3, Grant has only purchased around $138 to $140 million worth of property. Earlier I said that he'd probably need to purchase around $180 million of property. Therefore he's either not fully deployed all of the investors' money, or he's gone for a slightly lower gearing approach using a smaller loan and a bigger down payment. This means that Grant doesn't have enough property and therefore isn't making a big enough return to distribute the appropriate amount to investors. Maybe he's got some cash sat in the bank that isn't working well enough, or again he's maybe used a smaller and lower gearing approach. Or maybe Grant just couldn't find a suitable property or properties that were valued high enough, and therefore Grant had to maybe settle for a smaller property or fewer properties that weren't worth quite as much. Fund 2 pays out around $950,000 a year to $8 million worth of investors, which is obviously a very satisfactory return. Fund 3 only pays out around $1.6 to $2.1 million a year to $45 million worth of investors, which is a much lower return. It's a similar story for Funds 4 and 5, where Grant is generating good revenues and profits, but hasn't managed to buy enough property. In Fund 4, he's only bought around $258 million of property when he needs around $400 million of property. Again in Fund 5, he's bought around $189 million of property, but probably needs around $200 million of property. Now I think Grant is playing a really risky game here. When he uses a lower gearing ratio, like 60 to 70%, he just doesn't generate enough money to return to the investors. By the way, you can find the gearing ratio by taking the value of the investment from the investors, divided by the value of the properties, as a percentage, all taken away from 100%. This kind of forces him to take more of a debt-heavy approach, which means that obviously by taking on more debt, he can buy a more expensive property, which might have more rooms to rent out to tenants, and therefore he gets more annual rent. Obviously his expenditure is fairly small, and therefore meaning that when he adopts a higher gearing ratio purchase, he has more money to return to the investors. We can see this in Funds 1 and 2 because he uses gearing ratios of around 75 to 80%, which is much higher, therefore meaning that he brings in more revenues, has bigger profits and can return a higher percentage to those investors. The problem with a highly geared approach is that it isn't necessarily the safest. If the market falls as a result of some kind of crazy event, like a global pandemic, then the property values could reduce and Grant could end up in negative equity. Now, Grant isn't too worried about higher gearing, and let me explain why. Being in negative equity with property isn't the same as being in negative equity when trading leveraged stocks. If you're trading stocks on margin and your investment starts to fall, then you'll probably get margin called before your investment turns negative. This basically means that the stock trading platform or the clearinghouse will liquidate your position and sell your stock to save themselves from losing any money, and you bear all of the loss. But obviously if you enter negative equity on your home, then the external finance provider probably aren't going to sell your house. As long as you keep making your mortgage payments, they're happy. Therefore, Grant isn't too worried about entering a negative equity position right now because no one's going to sell all of his properties and liquidate the fund. But it might make it a bit more problematic for him 10 years down the line when he wants to liquidate the fund and pay back all of the money to the investors. He has promised a 2.5 to 3x equity multiple, and obviously if in 10 years property values have gone down instead of going up, then he's not going to be able to sell them for 2.5 to 3 times more than he bought them for. Let me know what you think about Grant and his funds in the comments below. Do you think it's okay that Grant isn't returning what was promised to investors? Do you think it's a good business model that Grant kind of almost has to be fairly highly leveraged to be able to make those promised returns? Now, Grant isn't too worried about the property market crashing because, and he noted it here in his interim financials, that in the second quarter of 2020, around 95.6% of his tenants paid their rent on time, and anyone that didn't pay on time has been put onto a deferred rent payment plan, meaning that they'll either pay it back later or pay it back in smaller chunks until they catch up. Therefore, I guess that Grant isn't too worried about the prices of multifamily real estate crashing because most people are still paying their rents. And that's a fairly reasonable assumption to have, as property values in the US for multifamily tend to depend on cap rates and the rents. I guess we'll have to see how many tenants pay their rent on time for the rest of 2020 and 2021 to know for sure. So I guess I'll just see how it goes and keep you all updated. But from the interim financials, it does look like distributions have fallen quite a bit from last year due to quite a heavy fall in distributions in quarter 2, which the fund does blame on COVID-19. Although that fall in distributions looks quite a bit bigger than 4.5%, which is obviously the difference between 95.6% and 100%. Maybe tenants have been leaving rental contracts early, and maybe Grant's occupancy rate is down as well. All in all, from my review of Grant's financials, he doesn't appear to be doing too badly. His funds aren't making massive losses, and he doesn't have waves and waves of personal expenditure going into his funds as well. His funds are actually generating profits and making returns to investors, just not those returns that were promised. Obviously, Grant has taken quite a low gearing approach in some of his funds and might need to take a higher gearing approach to be able to meet those investor requirements. Obviously, it's not good that he's currently not distributing enough to the investors, so hopefully he can resolve that. Maybe he can buy some more properties or take a higher geared approach and then buy some more properties or buy bigger properties or raise the rents maybe. As always guys, if you enjoyed this video, then be sure to check out some of my others. Alternatively, subscribe to the channel and ding the notification bell. That way you'll be alerted when I upload a new video. Cheers!